Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action because we are losing a bit of steam as we head into the final hour of trading. The Dow, which was up over 300 points at the highs of the session, now in negative territory. We're off just about 73 points. Taking a look at that intraday chart, you can certainly see the steady move lower over the last couple of hours. Taking a look at the S&P, though, that's still holding on to gains, although well off the highs of the day, up just about 0.2%. The Nasdaq 100, the outperformer of the three, now up just about 1%. We are getting more comments from Fed officials. San Francisco Fed President Mary Daly speaking today, saying rates might need to go above 5%. It was pretty similar, though, to what we heard from a number of Fed officials on Friday, although it seems like the market is looking at it through a different lens today. Taking a look at the bond market action, yields again pulling to the downside, off another 6 basis points in today's trading action. Taking a look at some of the leaders in today's market, I mentioned the outperformance of the Nasdaq 100, and you can see why. A number of the tech giants here outperforming today. You have Amazon up just about 2%, Microsoft, Google up just over 1%, Nvidia a standout today, as well as Tesla. Tesla off the highs of the day, but still up just about 6.5%. The sector action, still a bit of a mixed picture. Technology clearly leading the way. On the laggards, though, consumer staples and healthcare, the underperformers here, as it seems like investors still taking that risk on sentiment approach to the market today. Certainly going to be a huge week for investors. We had the CPI report on Thursday, and then big banks kicking off earnings later in the week on Friday. A number of the big names mixed today. JP Morgan, Wells Fargo, Dave, leading it to the downside here. Morgan Stanley and Goldman, though, still holding on to gains. Citi up well over 1% too.
The markets hear what they want to hear from the Fed sometimes, as we have discussed. All right, thank you, Shauna. Let's get you up to speed now on some housing data. Upbeat news like inventories in very short supply, but a housing sentiment did tick up from November to December. That's according to Fannie Mae. 21% of respondents say now is a good time to buy a home. While still pretty low historically, that's up 5% from the prior month. More consumers also now believe prices will fall over the next year, and more also believe mortgage rates will continue to fall with it. The average 30-year fix most recently at 6.48%. That is down from north of 7%. Still more than double this time last year. I don't know if you've seen the movie What About Bob? It's all about baby steps in that movie, and that's really what this is. It's not great news that 21% feel good. Yeah. But it's a step in the right direction.
I know. We got to take what we can get in this market, in this economic environment. That has clearly been the message that what we have seen from investors. And certainly it's an approach that we are starting to take over the last several weeks, searching for any sort of optimism. So, yes, an improvement there when it comes to sentiment about how people are feeling about the real estate market. But there's certainly, I think it's fair to say, likely going to be some pain ahead. We've gotten a number of predictions from the biggest banks warning that the next couple of months, especially the first half of 2023, are going to be tough. A number don't really see it significantly improving until potentially the end of the year, looking into 2024. So the next couple of months are certainly going to be pretty rocky, I'd say.
Yeah, it really depends on how you see that news, because as we just mentioned, more people believe prices will come down. And I think from what I'm understanding, probably low single digits in the first half of 2023. But will mortgage rates fall fast enough, far enough to get people off the sidelines? I don't think a low single-digit drop in home prices are enough to unfreeze this market unless you see mortgage rates get down below 6 into that mid-5s. And we're nowhere near that happening, with still probably 50 to 75 basis point hike from the Fed on the way. So
yeah, and the Fed, once again, being very, very hawkish, not backing down, saying that they're not going to be changing or pivoting anytime soon. So we'll see.
Yeah, let's talk about some of those, that Fed speak and what the markets are doing now with Brad McMillan, Commonwealth Financial Network CIO. Good to see you, sir. Let's start with some of the things out of the Fed today. Bostic, GDP growth of 1%, no recession's his base case. Perhaps Mary Daly moved the markets by saying, inflation should be low 3% by the end of this year, which I think is pretty optimistic, but that rates will go above 5%. Is that enough to move markets?
I don't think so, because what we're seeing right now is you're talking about the short-term rates, you're talking about mortgage rates, and that's great. But I mean, really, when you look at the longer term, when you look at the 10-year, the market is saying, the economy is saying, we don't really care over time what the Fed's doing. Inflation is going down. We're discounting the next 6 months. So I think the market's already priced in what the Fed's doing. And I think that we're just getting glitches here. We're getting little bumps. We're not getting a lot of reaction. And that to me says the Fed is pretty much out of the influence business at this point.
Wow, so you don't think maybe a hawkish Fed, some hawkish commentary then from Fed officials over the next several months, that could push markets lower? Because we have heard from a number of our guests over the last several days saying that markets in 2023 could retest those 2022 lows pretty soon.
That's certainly possible, but I mean, what's going to drive it? Is it the Fed? I mean, Powell has been extremely clear that he wants to keep raising. You know, we've got other people saying that the terminal rate's going to be above 5, and we still see the 10-year dropping down. Stocks are long duration assets, as you know. So, you know, longer term inflation will go down. We're already seeing the Fed start to realize that and start to indicate that. So it's a question of when, not if. And for longer term assets like stocks, it's not going to matter that much. It's really going to be about earnings, in my estimation, not about the Fed.
The Fed will learn a lot this week. We'll get CPI on Thursday, and Friday the fun really begins. You mentioned ratings. All the big banks start pouring in on Friday. What do you expect we will learn about the state of the economy over those 2 days?
Well, when you look at the financials numbers, I mean, they basically make their money on the rest of the economy. So if they're doing well, then I think we're going to have good news ahead. And you know, the real question here is not whether we're going to get a recession. I think that's baked in. We might get a soft landing. But the question is, how bad will it be? And between the jobs numbers and between what the banks are going to say, if the news is good, we're going to say, even if we do get a recession, it's not going to be bad. And that's actually going to be really good news for the rest of the earnings universe as well. And that's what I expect to happen.
Brad, what are your estimates when it does come to earnings? Because certainly a number of forecasters are saying that revisions need to be revised, earnings estimates need to be revised lower here, even though they have been up until this point. It sounds like, though, you disagree with that.
I do disagree with that for a couple of reasons. First of all, when you look at the actual results, analysts are almost always about 5% too low on earnings. Okay. And what typically happens is they will revise it down because you'll have CEOs and CFOs going out there and saying, oh, you know, my golf game isn't that good. My back is hurting, yada, yada, yada. But in fact, they want to talk it down. And so the actual numbers start to come out better. And when you combine that factor, which is kind of company specific, and with the fact that I don't believe the economy is going to be nearly hit as hard as the market now thinks, I think you've got two tailwinds. And I think earnings are actually going to come in, maybe not this quarter, but for this year as a whole, I think you're going to see gains. And I think they're going to be in the 5 to 10% range, maybe better.
Because of that setup, what are some sectors you like ahead? And your golf game, how does it impact your projections, Brad?
My golf game is pathetic. I do my best, but that's all I can do. My investment game is a little bit better. And what I'm looking at, I'm saying the consumer, the average person is going to keep working. You're going to see as inflation goes down, you're going to see real wages help. So consumer staples are going to continue to do well. I think financials are going to do well because right now you're going to have an expanding economy. They're going to be able to take advantage of those interest rate swings. So I think those two are areas. And the other thing, and this is a slightly longer term play, but I think it will show up this year. When we look at deglobalization, we're seeing industrials actually, I think, is an opportunity going forward. So I think those are three areas that people aren't talking about right now. I think there's some real opportunities there.
Brad, one sector that you didn't mention, certainly getting a lot of love today, and that's the tech sector. A number of those beaten down names that had fallen out of favor over the last 12 months are seeing some buying action today. Are you seeing any opportunity there?
The tech sector, to me, is a play on interest rates at this point. I don't see interest rates coming back down in a serious way over time. So I think we are seeing the tech sector react to kind of the pullback in rates. But is that sustainable? I'm not so sure.
So you think rates don't come down till 24 and then we get back on board tech?
Well, remember, we're not talking about short-term rates. Stocks are long duration assets. We're looking at the 10-year. Right now, the 10-year is about 3.5. They're about 3.5, 3.6. And that's already pulled back about 4.25. So, you know, is that going to go back to the levels that where we saw the previous valuations justified? I don't think so. I think the 10-year is going to be in this range, maybe even go up a bit. So over time, I'm a little bit cautious about tech.
All right, Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Thanks so much for joining us here. Well, we are just getting started on Yahoo Finance Live. Coming up, shares of Lululemon off just about 9.5% after the company provided updated guidance. An analyst will tell us what investors should do. Ferrari was named a top pick by Bank of America. Find out why. And see why Seattle schools are suing social media platforms like TikTok. Don't go anywhere. Lululemon shares sliding nearly 10% today after the retailer updated its fourth quarter guidance. Investors stuck on the company's gross margins for the quarter, with Lulu now projecting margins to decline between 90 to 110 basis points year over year. This coming in lower than Lulu's initial projection for positive gross margin growth of 10 to 20 basis points. Wall Street analysts reacting to that announcement today. Wedbush Securities cutting its price target on the stock to $380 from $430. The analyst behind that call, Tom Nikic, joining us now, Wedbush Securities, a senior vice president of equity research. Tom, it's great to have you here. So certainly I think this might have caught you by surprise, at least a downgrade that we saw in terms of guidance for gross margins. You were expecting a more upbeat guidance overall from Lululemon. So what do you make of the news today and the reaction that we're seeing in the stock?
Yeah, I mean, thanks very much for having me on the show, first off. And as far as what we heard from Lululemon this morning, so I expected them to raise guidance on both sales and the EPS lines. We got the sales raise that I expected. We did see very, very strong demand trends and very, very strong top line trends during the holiday period. The gross margin miss was a surprise, and this is the second straight quarter that they've missed gross margin guidance, which is not ideal. But, you know, when you think about it, right, like, I mean, they've talked about 100 basis points of margin pressure this quarter. You know, we heard from Nike a couple weeks ago, Nike's gross margins were down 300 basis points. Under Armour guided to Q4 or calendar Q4 gross margins down 600 basis points. Adidas talked about 900 basis points of pressure. So all in, down 100 basis points for Lululemon, not really that bad.
Why then a drop of nearly 10% on the stock? Is that an overreaction by investors?
I think it's a reaction. I mean, I think, look, like when you kind of miss gross margin 2 quarters in a row, it does kind of raise some eyebrows. In the grand scheme of things, look, like I think demand wins out in the end. And clearly what they told us this morning is that demand is really, really strong. They expect top line growth to be up 25 to 27% in the fourth quarter. Really, like I think that in the long run, this is going to be much ado about nothing. And as they clear through some of the excess inventory that they've got, I think everything will work itself out in the end, and they'll have a pretty good 2023.
Yeah, Tom, speaking of that excess inventory level, certainly what has been in the 80s now in terms of percentage growth in Q2 and Q3 on a year-over-year basis. It was interesting, though, in the last earnings call, we did hear from Lulu execs. They defended that jump, saying that they were too lean in the past and they strategically positioned inventory to be able to capture that guest demand that they were expecting this year. Is that then, are you at all looking at this as maybe it is a smart strategy?
Yeah, I mean, look, clearly last year there were all types of supply chain issues and there were inventory shortages and stuff like that. And they have really, really strong demand and they want to be able to capitalize on that demand. The other thing that I think is encouraging about Lululemon is a lot of their product is core seasonless product that you can sell year round, right? Their core black yoga pant, their ABC pant for men's, stuff like that. So, I don't think having high inventory growth is as concerning for a business like Lululemon as it is for something, for a brand that's more seasonal and you really got to get stuff out the door, in December or else you're not going to be able to sell it. So I don't think it's as troubling as it would be for many other brands.
Speaking of other brands, you mentioned some of the other margins that look far more problematic. How difficult overall do you think this quarter is going to be in the retail sector?
Look, it's going to be, it's been very promotional, and especially in light of what we saw in the holiday 2021 period where discounts were very, very hard to come by a year ago. Discounts were very easy to come by this year. And I think that's well telegraphed at this point. I think a lot of companies out there have talked about having tough margin performances this year. The question mark becomes, how does demand hold up in 2023? Because demand has held up relatively well in spite of inflation and some other factors. And so, I think when we look ahead, it's going to be, I think we're going to be in a position where the strong brands will continue to perform well and will continue to generate solid demand, and it'll be tougher for some of the other players in the space.
Yeah, Tom, speaking of that, seeing clear winners and losers within the space, you cover a number of companies: Nike, Poshmark, Under Armour, Steve Madden, Allbirds, just to name a few of the other companies that you do cover in the retail space. We also got the news recently about Stitch Fix laying off a large percentage of their workforce, citing the slowdown of what we could see heading into the new year. What's your gauge just in terms of layoffs and what that could potentially mean for retail over the next couple of months?
Yeah, I mean, look, clearly this is the second round of layoffs that they've done in the last 6 months, which clearly tells you that things are tough at Stitch Fix. Lululemon is a business that's got a lot of momentum. Stitch Fix is a business that does not. And their sales trends have been heading in the wrong way. Sales trends have decelerated, 4 or 5 quarters in a row. The issue I see with the layoffs that they've been doing, and they also have a strategy to pull back on marketing expenses. Yes, that will help the cash burn of the business. Yes, it will help the EBITDA line. You know what it doesn't do? It doesn't really help turn around the top line. And ultimately, I think that revenue is the elixir to, any retailer's problems. And, if you're doing things that make it harder to turn around the top line, then it's tough to have visibility into a turnaround at Stitch Fix. So I understand why they've implemented the cost-cutting initiatives that they have, but I'm not sure it's going to do much to turn the ship around.
Yeah, tough to cut your way to wins in that environment. Tom Nikic from Wedbush, good to see you, sir. Thank you. All right, coming up, Tesla price cuts in China look like they might be working. We'll tell you why. And Piper Sandler recommends pairing Uber against DoorDash. Find out why when we come back. Tesla is cutting prices and extending delivery times for its vehicles in China, decisions that have sparked ire among those who already own Musk company EVs. For more, we're joined by Yahoo Finance senior autos reporter Praz Subramanian. Praz, what's the latest here?
So, we saw those price cuts on Friday, led to some protests this weekend in places like Shanghai and Chengdu. Owners upset that they pushed their order, their purchase ahead of time, ahead of the new year, because they wanted to get those tax incentives to get to your pricing. But now they're saying, hey, what's with the price cuts? 10% for the Model Y, 13.5% for the Model 3. Not happy about that. Tesla China says they're not going to offer rebates, refunds. Sorry about that. But a good thing for Tesla is that we're seeing wait times for some of the Model Ys extend a week or so out, because it's potentially the fact that these price cuts have ginned more demand up here in the country. So we're seeing that happen with the Model Y long range and all-wheel drive going up to 2 to 5 weeks for delivery in China. So that's a good thing for them. But this is potentially more demand in a really highly competitive Chinese market.
I'd be pretty angry, man. 10% to 15%, just like that. You'd want that back.
You missed the sale. You're out of luck.
Yeah,
you need some
right.
free charging.
You're right.
You missed something.
I don't know. We'll see whether or not it really actually boosts demand in the long term here. But while we have yours, because we also want to talk about Ferrari. Bank of America now saying that Ferrari has a pretty positive future when you take into account one of the top picks for 2023. Why do they like them so much?
They had a fairly extensive note here on 5 auto trends and themes, and they said that with an environment where lower volumes are going to be kind of the norm, a company like Ferrari is sort of in the right position, pole position, if you will, because of the, they don't have huge volumes to begin with, so they're going to keep their volumes kind of low. They can boost prices and people will still pay for them because it's a coveted brand. They have licensing opportunities, even F1, the F1 effect is big for them. And then also a commitment to, quote, preserving the exclusive luxury culture, which again means lowering volumes, keeping them low, high prices. It's a good mix for, I guess, in the future when we look at the auto industry going up right now.
We will see how or what people are willing to spend on auto. Certainly, maybe the sector not so much impacted by the slowdown that we could see. Praz, there was also an interesting call comparing Uber and DoorDash today. And this was out from Piper Sandler. And they made a case saying that Uber is much better positioned than DoorDash in this economic environment, and that they would actually outperform during a recession based on the fact that people are not going to buy a new car, replace the car that they have, given the fact that new car prices are not too far from the all-time highs yet. And then they will therefore spend that money on Uber and Lyft, not so much on DoorDash. I'm scratching my head here. Dave, you are too.
I'm so skeptical of this.
I'm trying to connect A to B. I get the overall theme of it, that people can't simply afford a new car. I don't know if you should be then paying day in and day out for Uber and Lyft. Doesn't really seem like a cost-saving strategy.
I really don't see the correlation to higher car prices, spending more money on ride sharing, and then not saying that the food deliveries are going to be successful. Yeah. So there is a whole lot of mix. I mean, what was it? 36% of Uber's revenue comes from food deliveries. So this is a whole mixed up development for me. Shed some light on this.
I mean, I'm with you on the fact that Americans like their cars, right? They're not going to replace going places with just strictly Uber and Lyft, right? I find it funny. This is a classic Paris trade. I haven't seen a Paris trade call in a while, right? Buy Uber, sell Dash. They really said we're not like really hating on Dash. We just think that compared to Uber, it's a better pick. And like I said, Uber does have a high exposure to deliveries, but they have a claim to a much more higher kind of volume, able to spread those costs over with, I guess, their platform. I think the biggest thing is that people, I don't think, are going to replace all their driving with Uber and Lyft. They might do some of it in the cities, but I think there's still going to be a demand there for cars, and Uber is not the substitute.
Well, and also with this line of thinking, you would also think if people then don't replace their cars, they are using Uber and Lyft more, they don't have access to the vehicle, they're probably not going to the grocery store as much, so then you would think that maybe they are still ordering in more than they would be, and then it would almost be a win for both in that sort of scenario, right?
Yeah,
I just don't get the
because you're going to be using DoorDash anyway, right? Yeah.
You need people to bring you food. You don't have your own car to go out to the grocery store.
Right. The thesis is we're not going to be buying cars, then we're going to be using Dash and Uber all the time, right?
Yeah, I don't know.
I want to disagree with you. I just really can't find the correlation. I think people are going to hang on to their cars longer in a recessionary environment and probably avoid ride-sharing apps because the prices, quite frankly, have gone up quite considerably over recent years. Get on Uber or Lyft right now, I find it unaffordable in the last 6-9 months. And if anything, I'm going to cut back on that in this type of inflationary environment. That's just one person's perspective, but
I don't know.
We're struggling.
But it's also, Piper Sandler is not alone in this. It seems like we are almost on an island by ourselves because Jeffrey also initiated coverage with a buy on Uber, a sell on DoorDash. They didn't make the comparison between the two, so digging into this report, certainly a different investment thesis here as to why they like Uber and why they don't like DoorDash. DoorDash is saying slowing outlook, which we've been talking about. Also, the fact of where DoorDash is trading today compared to some of its competitors out there, more expensive. Uber, they see improving sentiment on profitability. So a different call there from that analyst from Jefferies, but the same ratings on both Uber and DoorDash.
I think one thing that will help Uber and Lyft is New York City courts ruling against the drivers, say they will not get the pay raise that they were fighting for in court, and that certainly boosted the stocks of both.
I will say Uber, I think it's a better play than, let's say, a Lyft because of the global sort of reach. Yeah. And the deliveries also is a big, Uber Eats is a huge business. Actually, it's a very well-run business. Dara Khosrowshahi really kind of making that platform kind of what it is now compared to when Travis Kalanick was there too. So I think Uber is sort of like the beginning stages maybe of their sort of run in mobility.
All right, Praz Subramanian, thanks so much for hopping on set here with us. Coming up next, despite the challenging housing environment, Zillow getting a double upgrade today. We'll tell you why when we come back. Time for Triple Play. 3 stocks that we're watching in the final 30 minutes of trading. We have Zillow, Nvidia, and Goldman Sachs. Dan Halley here to help us break down some of these big movers. Let's kick it off with Zillow. Today's gain, a huge jump to the upside. We're looking at gains of just about 7%. Was trading up about 10% earlier in this session. The biggest daily jump that we have seen in the stock in about 2 months. The gains coming after Bank of America turning bullish on Zillow, upgrading the stock 2 notches to buy from underperform. Now, in a note, analyst Curtis Nagel writing that while early 2023 is going to be a challenge, he and his team are, quote, more confident that growth can return to double digits in 2024 on improving affordability. New price target of $42, higher from where we're trading today, substantially higher from the $22 price target that it had on its previous rating. Zillow, the best performer among its peers today. And Dan, we were talking early in the show about the challenge that is facing the housing market right now. It might not improve over the next several months, but at least when we get to the second half of the year, out into 2024, it looks like Bank of America joining the outlook there that things are only heading up from here.
Yeah, I mean, that's, obviously the prediction here. Look, my wife and I are looking to buy a house at some point this year. We don't know exactly when just yet. We have friends who got locked in with great interest rates. Obviously, the interest rates right now nowhere near the 2% that some people managed to lock in. So makes it less appealing at this point. But I think like people who are in my position who want to start looking or are already looking, there's never going to be a great time. So I think it's the shock of the interest rate jumps and then obviously just kind of having to contend with that. But I want to hit my pick for the day, and that's Nvidia. This stock has been absolutely hammered over the past year. The last 12 months, it's down nearly 45%, a little more. But today, it's actually having a good day, up around 6%, I believe. Basically, what's going on here is it got a top pick from Wells Fargo, as well as Credit Suisse, both of them in different ways. Wells Fargo was looking at the data center business for the company, essentially saying that they expect to see that kind of get increased in 2023, while Credit Suisse is looking at the gaming side, seeing increases. It's worth pointing out that Wells Fargo also added AMD to its top pick list. Look, Nvidia has a huge market when it comes to the data center business. It's beating out the gaming business by a mile at this point, especially as we saw the gaming business get hurt because of those rough comparisons between 2020, 2021, and then 2022. The gaming industry just suffered massively as a result. But we're starting to come around on those comparisons. We should start to see it rebound in 2023. And I think that's really what these companies are looking at.
And AMD, Dan, also up about 6%, perhaps on this same news. It was last month that UBS picked AMD, NVIDIA, and Micron, top semiconductor stocks for 23. But Citi also out with a note most recently saying they expect semi sales down 10% in the quarter. That's up from their previous prediction of 7%. So the news has been mixed, if anything. And we thought that CHIPS Act was going to be a real catalyst for the whole industry. Really has turned out to be anything but perhaps in the long run, they'll be right here. My play is Goldman Sachs, who, according to reports, will lay off as many as 3,200 employees. Macro uncertainty forcing them to search for cost savings. More than a third of those job cuts are expected in the trading and banking units. Like most big banks, Goldman has been hit by a slump in global deal-making activity. The bank's third quarter revenue dropped 12% from a year ago. Investment banking has been the key, revenue plunging 57% year over year. They will report earnings 1 week from tomorrow. The big bank earnings get going on Friday, so we'll get a better glimpse at the sector. As for today, you can see shares up just over 1%. Investors, generally speaking, cheer this type of news. Could end up being the biggest layoffs since the financial crisis, Shauna. Usually, I would think investors would cheer it a little bit more, being that it's fairly large cuts, but there looks like there's more to come in this sector.
Yeah, large cuts when you compare it to Goldman Sachs' overall workforce amounts to just over 6% of its workforce, which is actually below what was reported as kind of the upper limit last week when there were reports that Goldman could cut up to 8% of its workforce. So maybe this was less than what the street was expecting. It's going to be interesting to wait and see what we hear from David Solomon, what we hear from a number of the bank CEOs over the next week or so, because I think a lot of the market activity, at least over the next several weeks, is kind of going to be based off of what we did hear from the banks. We know how integral, how important they are to this earnings season. We heard it from Brad, our markets guest, earlier on in the program. That's really going to set the pace and really set the scene for earnings this season, when so many analysts are worried about some of those downward revisions and how bad it could potentially get.
Friday could be a tough one. All right, Dan Hadley, thanks for playing with us on Triple Play. Coming up, from inflation to housing to the dollar, we'll tell you S&P's economic predictions for 2023 after the break. Stick around. We entered 2023 amid major Fed tightening, high inflation, and tech layoffs. What can we expect from the economy throughout the year? Here with some predictions is Sarah Johnson, S&P Global Market Intelligence Executive Director. Sarah, nice to see you. Let's start with inflation, the big question on everyone's mind. And Mary Daly from the Fed says 3% by later this year, which would be welcome news for the consumer. What's your projection?
Well, for the U.S., we're projecting a significant deceleration in consumer price inflation. Depends on which indicator you look at, but the Federal Reserve tends to be focused on the personal consumption deflator, the core deflator. And yes, that could easily get down to the 3.5% range by the end of this year. Globally, we see inflation at about, well, last year 7.7%, this year about 5%, and next year 3%. I mean,
Sarah, what does all this then signal just about how aggressive the Fed needs to be in order to meet those inflation goals, and what that means for the odds of a recession, whether or not we still have maybe the option or the ability to avoid one at this point?
Well, the recent news has been somewhat encouraging in that labor cost increases have been a bit milder than previously reported. We've seen significant declines in industrial commodity prices over the past 9 months. And we see some normalization of supply chains. So clearly, disinflationary forces are at work, but we are concerned that labor markets remain extremely tight, and we will have to suffer some increases in unemployment to avoid a protracted period of above target inflation.
Though it's just hard to see it. 3.5%. That labor market, to your point, remains extraordinarily tight, continues hot month after month. Where do you see it going throughout this year in terms of our unemployment rate?
Our forecast has the unemployment rate rising to a little over 5% by the end of this year. So yes, we see a mild recession over the first 2 quarters of this year, helping to bring down both top-line inflation as well as labor cost inflation.
And Sarah, when it comes to the U.S. dollar, certainly likely to be a topic that we are going to hear from a number of companies over the several weeks when we get earnings season underway. We are certainly have seen some improvement when it comes to U.S. dollar index, pulling back just a bit right now at 103. Do you think that trend, the downward trend that we've seen in recent weeks, is that going to stick this year?
I would expect that there might be some downward drift, but not significantly. We believe the dollar peaked last fall and will come down as other countries raise their interest rates. But I'd say interest rate differentials will continue to favor a relatively strong dollar, but we could see some corrections in the yen, for example, which had an exceptional move during 2022. So I'd look for a somewhat stronger yen. The euro will probably hold on to its recent gains, particularly given the more hawkish sentiment from the European Central Bank.
The housing market has seen month after month of really difficult data. How far do you see mortgage rates coming down, flattening out? And what about home prices, your projections for 23?
We expect that mortgage rates will edge down a bit, but certainly remain far above where they were a year ago. So the outlook for housing demand is certainly not an optimistic one. We expect further weakness in home sales and housing starts. Home prices will probably have a peak to trough decline of about 10% nationwide, but certainly steeper declines in some of the markets that were exceptionally hot during 2021 and 2022.
Certainly going to be a tough start to the year for housing. Sarah Johnson, thanks so much for joining us. Well, coming up, the price of Bitcoin topping $17,000 for the first time in weeks. Find out what's behind the recent climb next. Bitcoin breaking above 17,000 after trading in that $16,000 range for roughly 3 weeks, certainly staying there at least for now above a 17. Let's talk about what to expect going forward. Yahoo Finance's David Hollerith joining us. And David, some buying there, some movement to the upside along with stocks on the heels of that jobs report that we got last week.
Right. Yeah. I mean, over the weekend, too, we saw, especially last night, we saw sort of a slight, what you'd call a slight rally. And analysts are saying that the crypto market shift largely appears to be driven by macro events this week, like stock and bond investors. Crypto traders might be grabbing a hold of the latest inflation and employment data as a reason to believe the market could be turning around. And while it hasn't been the case lately, Bitcoin and other cryptocurrencies are usually more volatile and trade ahead of other assets during rallies and sell-offs. So the events that they're paying attention to this week, no doubt, would be the latest inflation reading, and then any sort of evidence of clarification on digital assets from bank earnings. And then also on tomorrow, we'll have Fed Chair's Powell's speech at the Reichsbank Symposium. And that may also provide a reminder to the market that the Fed's job is far from over. So, we're seeing this as, many observers, I think, are seeing this as turnaround as maybe a tenuous bet at this point. But crypto investors are clearly in need of some recovery. And this is sort of a reminder that cryptocurrencies, Bitcoin and Ethereum, most of all, are macro assets. And that's how they've traded despite these industry-specific events that have been major sell-offs, such as the FTX collapse and what we saw over the summer.
And David, BlockFi in bankruptcy court today. What's the latest there?
Yeah, BlockFi plans to file a schedules of assets and liabilities and statement of their financial affairs on Wednesday. And this is going to give creditors and other onlookers a better view into the company's balance sheet gap between its assets versus how much it owes customers. Lawyers representing BlockFi, who also represent Celsius Network, also made a point of showing that the company's executives did not make any crypto asset withdrawals on BlockFi's platform prior to October 14th. Obviously, BlockFi filed for bankruptcy in November. And the point here is it's, at least he was suggesting that unlike Celsius, there's probably less evidence of fraudulent insider activity in this case. The judge also, during the hearing, denied BlockFi's request for the turnover of the coveted $470 million worth of Robinhood shares that was purchased by FTX's former CEO, Sam Bankman-Fried. Now, on Friday, we did find out that the Justice Department clarified that they had taken possession of those shares and $21 million in cash from an SBF-linked company. And, at this point, it's just too early to determine who has ownership over those assets, whether it's BlockFi, because shortly before filing for bankruptcy, SBF did promise them as collateral for a loan, or if it belongs to the FTX bankruptcy estate. But that decision needs to be determined at a later date, and the judge has denied the motion.
Okay, David Hollerith there with the latest in the crypto space. Thank you, sir. Appreciate that. Disney employees celebrated the triumphant return of Mr. Incredible CEO Bob Iger less than 8 weeks ago. But they might see him as more of a Scar or Jafar today. Iger, who's already signaled cost cutting will be top of mind in the new year, now says it's time to return to the office. Starting March 1st, employees are expected to be back 4 days a week. The boss writing in a memo obtained by Yahoo Finance, quote, "In a creative business like ours, nothing can replace the ability to connect, observe, create with peers that comes from being physically together, nor the opportunity to grow professionally by learning from leaders and mentors." Shauna, your reaction?
It's going to be interesting to see what the employees' reaction is, because we have cited study after study saying how important it is for workers to have that flexibility. They want to work from home. There was a recent ZipRecruiter survey out saying that employees are willing to take a 14% pay cut just to be able to work from home. So I think the big question here is who has the upper hand? Is it still the employee, which has certainly been the case leading up until now, because we know hiring has been so challenging, quitting has been so popular. That dynamic, though, is starting to shift. And it seems like the employer is going to have and will have the upper hand as we do potentially the economic backdrop continues to worsen. They are forced to do layoffs. Employees won't be able to ask for what they had in the past. They won't be able to get away with what they've been getting away with in the past if, in fact, their bosses, management wants everyone back to the office.
Yeah, that same study showed you'll get 3 times as many applicants for remote work as you will in office. I think there's a real test of the very signature quality that everyone hailed when Bob Iger came back. It's that deft, personal touch in handling employees, in handling the media, and handling politicians. My presumption is that if the same statement came from Bob Chapek, it would probably not be taken as well as it might be from Bob Iger, but that's part of why they brought him back. Now, the actual statement that he wrote in that email, I have to agree with, spot on. What he needs is collaboration. What he needs is employees learning from mentors, people seeing each other face to face and building on that. And quite frankly, from this seat, 4 days a week sounds awfully nice, right?
Does.
Now, it doesn't sound great. Yeah, it doesn't sound great to a lot of those that are used to the 2 and 3 day. But look, you're still getting a full day at home working from remote, which is more than you probably ever thought possible prior to the pandemic. So we'll see how employees react to your point.
I think it makes a very strong case, but we'll see. I don't know how they're going to react.
All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
We're just minutes away from the closing bell. We want to take a look at some of the big movers of the day. First up, let's take a look at Duck Creek Technologies. You're looking at gains today of just about 46%. This massive move to the upside that we're seeing coming after Vista Equity Partners coming out saying that they plan to take Duck Creek private in an all-cash $2.6 billion deal. The stock now trading just around $19 per share, which was offered by Vista. Now, the deal expected to close in the second quarter of the year would bring an end to what has certainly been a tumultuous run in the public markets for Duck Creek. Now, Duck Creek IPO'd back in 2020. When we take a look at that max chart, you can certainly see we're well off the highs there, the all-time high just below $60 a share, where we are today with today's massive jump, still just around $19 a share. And Dave, taking a look at those losses from that max chart of just about 52%.
Yeah,
they needed to do something.
That's where I was going to go with this. It really depends on your perspective. $59 is a significant markdown from their peak, but where they're trading now, massive upside compared to where that stock is trading today after losing, 60%. They lost from their market cap just last year.
Yeah, certainly a tough environment there for the company. Let's take a look at Alibaba, because a big move to the upside today on an intraday basis. We're looking at gains of just about 3%. Now rising with founder Jack Ma relinquishing his ownership stake in Fintech firm Ant over the weekend. Baba also receiving positive notes from Morgan Stanley and Goldman today. Morgan Stanley listing Baba as one of its top tech sector picks. Morgan Stanley believing that investors have unappreciated Alibaba's leverage to a consumption recovery in China. Now shares of Alibaba have lagged over the last year. China's COVID recovery has been slower than initially anticipated. Taking a look at what we've seen over the last couple of months, we're looking at huge gains of just about 36%. But of course, that jump there, Dave, coming after what has been a rough go at it for the company over the past 2 years, we're still looking at losses of about 53%.
Yeah, speaking of tumultuous, with Jack Ma and Ant Group, go back to October 2020 when it was nearly worth $900 billion. And he said, quote, "Without risk, no innovation can happen in this world." The very next month, they whacked that IPO, cracked down on China's big tech, and the rest has been that chart.
Yeah, been trading just right along the bottom here over the last year, and today right around $110 a share. Let's take a look at Macy's very quickly. A mover here in today's action, looking at losses of just about 7%. Now this coming after the retailer warned investors it might not be too happy with their holiday as season numbers here. Macy's stating that its fourth quarter net sales will likely come in at the low to midpoint of initial guidance. So things certainly not looking too optimistic with the stock today, Dave, of losses of just about 7.5%, still above $20 a share. Let's get you over to that closing bell.
All right, folks, there is your closing bell on Wall Street for this Monday. As we start the week, let's take a look where the markets finished today. And the Dow's been a wild ride this afternoon. Finishes up down 112 points, and the S&P barely in the red, just losing 3%. The Nasdaq really the winner today based on, largely speaking, a big jump for Tesla, solid day for Apple, up 66 points. Here's an interesting number. The S&P finishes the year up 83% of the time when the first 5 days finish in the positive, so a barometer perhaps of the year ahead. Let's take a closer look at the broader markets and bring in Matt Stuckey, Northwestern Mutual Wealth Management Senior Portfolio Strategist. Matt, nice to see you. What do you make of the market action today? And getting back to that stat, the first 5 full days of trading, what have we learned?
Well, I think we have a continuation of what we've been dealing with last year, which is a lot of volatility, a few days up, a few days down in a row. And really what you're left with is kind of where you started. And it's kind of how we kind of see 2023 shaping up. We do see a narrative pivoting from inflation worries towards recession worries, which just means until the economy troughs and the Federal Reserve starts to back off, this volatility back and forth is likely to persist.
Matt, you mentioned recession worries there. What are you expecting? Do you think we will get a recession, and how severe could it potentially be?
Yeah, that's the big debate right now, the debate between recession versus soft landing. And, we're kind of starting to talk about our outlook from a macro perspective as more of a soft recession, something that is shallower and probably shorter than prior recessions, especially the most recent ones where we saw massive reductions in GDP and increases in unemployment. But if you look at what's in front of us, we have the bond market that's as as deeply as inverted as we've seen in the last 40 plus years. We have leading economic indicators from the Conference Board that are negative 7.3. You've never been at these levels before and not had some sort of recession here in the United States. And, you put on top of that, though, what makes us optimistic that things are going to probably be a little bit less severe. It's the shape of consumers. It's the shape of businesses and banks, all well capitalized with strong balance sheets, which should help to weather the storm pretty well.
Yeah, you mentioned those banks. Those bank earnings start pouring in on Friday. What do you expect that we'll learn at the end of the week?
I'm not sure we're going to learn a whole lot from banks as we look to the upcoming prints later on this week. Capital levels should stay pretty resilient. Credit performance should stay pretty good, although normalizing back towards pre-pandemic levels. Capital market activity, however, from investment banking as well as equity and debt issuance and trading should be somewhat muted as a continuation of what we saw last year. But the bright spot is banks are still lending. They're still seeing net interest income rise, which should help put together fairly decent results. But the big question a lot of investors are going to have is around credit, and that we're not going to know until we start to see the labor market start to crack a little bit.
How much crack do you think we're going to see in the labor market? Because I think the big question is whether or not we need to see substantial job loss, how weak it needs to get in order to see significant inflation improvement. What do you think?
Right now, I think we're seeing some mixed signals in labor. And, to be honest, the labor markets have been a lot more resilient than we would have expected at this point. Last Friday, we got the jobs report and, the headline number was pretty good. But, underneath the surface, there were some mixed signals, which I think kind of sparked the rally this past Friday. We saw average hourly earnings miss expectations and come in underneath what the market was expecting. That's a good sign in terms of inflationary pressure starting to come off as it relates to labor tightness. We also saw average work weeks move lower, the second lowest level they've been at since the pandemic started, which just means that companies are seeing moderating demand. And as a result of that, they're starting to require less hours from their workers to meet that demand, which should bring overall labor pressures down a little bit, which is what the Fed wants to see. Speaking
of the Fed, Mary Daly says inflation low 3% later this year. Is that where you project?
We actually think it might be a little bit lower than that. If we're looking at the inflation story today, just look at the last 5 months of CPI prints. We're going to get another one this Thursday, and we think it's going to be a continuation of this trend, which is strip out the lagging parts of inflation. Shelter is the big one here, and look with what you're left with, and it's a cumulative negative inflation number, a negative 0.2% over the last 5 inflation reports if you strip out the lagging shelter component, which, as we all know, enters into CPI with a 1 to 1.5 year lag. And if you're looking for kind of your more up-to-date kind of pulse of the market, shelter inflation numbers, those numbers are negative. If you're looking at home prices or month-on-month rent levels, those are moving lower. And so that's kind of baked into the cake for kind of where inflation is going to likely be as we move throughout 2023 and into next year. The downward pressure is certainly starting to show through here.
So Matt, how does all this then shape your investment strategy and what you like now?
Well, we're fairly balanced as it relates to overall equities versus fixed income. We did move a sizable amount into high quality fixed income at the end of the third quarter, as we see a lot of value restoration into the bond market. But we don't necessarily think it's time to just shelter up and hide away from risk assets. There are parts of the market that we continue to find attractive valuations. Those aren't necessarily found in the S&P 500. We do find those, however, in U.S. small caps and U.S. mid caps and international equities that have very large value spreads relative to where the S&P 500 trades. But even within the S&P 500, if you take more of a value factor look at it, there are values there that trade 11, 12 times forward earnings, which gives you a lot of cushion if estimates get cut as we move throughout this year with a recession on the horizon, that a lot of valuation discount is already kind of embedded into the price here.
All right, Matt Stuckey, always great to have you. Thanks so much for joining us here this afternoon. Coming up next, the mental health crisis among America's youth, why more school districts are holding tech giants accountable. We've got that for you next. Seattle's public school district filing a lawsuit against some big tech companies over harm that the district says that their social media platforms are causing and worsening a mental health crisis among their students. Let's bring in Alexis Keenan with the latest on this. Hey, Alexis.
Hi, Shauna. Yeah, this is Seattle's largest public school district with approximately 49,000 students. They filed in federal court in Washington against the social media companies that you mentioned there and their respective parent companies. And the claim here is that the companies, their respective algorithms, they say, used for marketing and content, create feedback loops, they say, that harm the mental health of children. The district says that the design of these algorithms targeting children is what's responsible for a rise in depression, suicide, eating disorders, and even anxiety among minor students. Now, the district is asking for an unspecified amount of monetary damages. They also want an injunction to stop the alleged offending behavior. They say it's based on a claim that their finances and their operations in the district are suffering. They say that millions of extra dollars have been needed to be spent, enough to get enough counselors, nurses, psychologists, and also to conduct investigations that come over social media, threats against the school as well as threats against students. Now, the lawsuit goes on to cite just dozens of studies that suggest that social media has a negative impact on the mental health of children. One coming from the U.S. Surgeon General saying that 1 in 5 children ages 3 to 17 now suffer from mental, emotional, developmental, or behavioral disorders. So this is a really novel case. It's really saying that the district is being harmed in turn based on that student harm. So this is a different approach than some of the lawsuits that we've seen in the past. Guys?
Very different. And a movement really started by Frances Haugen, the former Facebook employee turned whistleblower. Alexis, could lawsuits like this actually force the platforms to change their algorithms?
You know, maybe there's so many different ways that individual parties as well as companies are going after this foreseen problem, at least allegedly foreseen. It's based, though, this lawsuit on a legal theory of public nuisance. Now, that's usually talking about injuries to the health and well-being of an entire community. So really broad sweeping claims, and they're difficult to prove sometimes. This is a type of claim that was attempted in a lot of the opioid cases, but very difficult. Particularly, I think the challenge here for the district is going to be both for the claim of potentially altering the algorithms for these companies, that the relief that they want there, as well as for any monetary damages, is going to be like causation. And that is proving that there's an exact link between the social media companies' actions, their algorithms, and the district's injuries that they're claiming here. So this is just an initial step. Only a complaint has been filed. We've reached out to the social media companies, and we'll be looking for their response to these claims.
We will. Alexis Keenan, you will stay on it. Thank you so much. An important story. All right, a still extraordinarily tight job market continues to result in strikes in various industries across the country. Today, more than 7,000 nurses at 2 major New York hospitals are on the picket line. The nurses from Mount Sinai in Manhattan and 3 locations of the Montefiore Medical Center in the Bronx say staffing shortages have left them burned out, underpaid, and unable to properly care for their patients. A 19% pay raise, apparently not enough to get the nurses back on the job. Montefiore nurse Michelle Gonzalez joined the show earlier today to voice her concerns. Listen.
Staffing has been a concern for nurses and for healthcare workers for a long time. And it's not just nurses, it's our respiratory therapists, it's our doctors are struggling with our patient loads. It's not just as nurses. But I think the short staffing affects all of us in the way that when we're trying to provide that care, we're unable to do adequate assessments to give the patients the kind of care and the time that they need.
Issuing a statement on the strikes, Mount Sinai saying, quote, the New York State Nurses Association continues its reckless behavior, rejecting Governor Hochul's proposal for binding arbitration. The governor's proposal would have provided a path to avoid this strike, which sadly is forcing nurses at the Mount Sinai Hospital to leave their patients' bedsides. Talks now were set to resume this afternoon at Montefiore, but there's no word when negotiations might resume at Mount Sinai. And Dave, I think this is just very sad for New York City. Yes, it's very important for nurses to be paid and to be paid what they think is right and what they think should be done, and necessarily what they do should be paid because of how much they work and what the importance of their job. 19%, though, that is a massive jump in pay, and yet that is not enough. And my heart goes out to everyone within the healthcare system right now, because it's certainly been a trying couple of years coming out of the pandemic. I think almost everyone who works in the healthcare system has been overworked over the last several years. My sister is a doctor in one of the New York City hospitals. She talks about it all the time. Staffing is and remains to be a massive issue within healthcare, and I don't see that significantly improving anytime soon. And when so many positions go unfilled at these hospitals, look, neither Mount Sinai nor Montefiore can hire the number of nurses that they need right now. So there's massive job openings there. Patients are at risk, and we're seeing that Mount Sinai moving babies that were in the NICU because of this as they prepared for this.
Yeah, that's where my thoughts went to initially. Those parents having had a kid on the NICU in the most stressful time of your life, now not having proper care for your kids. This is not to put that on the backs of the nurses, but that is a very difficult position. But nationally, you step back and big picture, look, we talk about the labor market, and the employee still has the power, and in particular in this profession right now where there is a massive shortage. We're talking about 20% shortage by 2025. Industry-wide nurses, people were getting out of that profession during COVID, and no one is going into it now. People are retiring. This is a problem they better figure out, not just in New York. This is a national nursing shortage. I hope the binding arbitration proposal at some point gets them back to these hospitals in New York. But nationally, we're nowhere near an answer to this problem, which is probably having to raise the pay across the board to get more people into this profession. Because if you don't, not just, I'm a son of a 20-year emergency room nurse, 20% does sound like an awfully lot. I think most people would kill for a 5 or 6% raise right now. Anything that covers inflation of around 7% sounds pretty good to most Americans, but long way from solving this national shortage. Doctors as well. Primary care is going to be a really debilitating issue for the healthcare industry.
Massive debilitating issue. We were speaking of those job openings, over 700 nursing vacancies at Montefiore alone. So that's just one hospital here in New York City. Over 700 positions open. Just really speaks to the magnitude of this issue that's facing the healthcare industry.
All right, indeed. Coming up, shares of Tilray falling on the cannabis company's quarterly earnings. We'll speak with Irwin Simon, Tilray Brands chairman and CEO. On the other side of the break, there he is.
The movie industry kicking off 2023 on a better note. Now, the first full weekend earning an estimated $104 million at the box office. That's up 60% from the first weekend of 2022. Joining us now with a full roundup is Yahoo Finance's Ali Canal. Ali, lots of expectations just in terms of Avatar's new movie, how many people are going to go out and see that. Seems like some of that momentum has continued into the new year.
Definitely, and I think there were two big movies that were driving a lot of the attendance this past weekend. You mentioned the Avatar sequel, and The Way of Water does continue to do what analysts said it was going to do. Ride that momentum, keep breaking records. Currently, the movie has earned more than $1.7 billion globally in its first 4 weekends. That makes it the 7th highest grossing film in history, with even more room to run. Director James Cameron, he said he fully expects this movie to surpass that coveted $2 billion mark. Now, that's been very hard for films to do amid this pandemic era. Even a film like Spider-Man No Way Home, despite all of its success, came in just shy of that $2 billion number. But the expectation is that Avatar will surpass that, and that's great news for James Cameron, because that is the break-even number that this film had to nab in order to make some money. So I think we can expect more sequels of this franchise in the future. And then I also want to call out Megan. This film surprised me, and I was talking to our producer Cheyenne about this. She went to go see it. She absolutely loved it. The reviews have been amazing, off the charts, near perfect critic score on Rotten Tomatoes, a lot of activity on TikTok because of this. And if we take a look at the numbers here, 30.2 million domestically, bringing a global total to 45 million. And the expectation was that in the domestic markets, it would secure just 17 to 20 million. So it nearly doubled that. And it's just interesting to see the momentum of the horror genre. We saw Paramount Smile perform really well. I think this is something that we could see continue into 2023, especially since we do have some pretty prominent horror films coming to the box office this year, like Scream 6, which I personally am very excited about.
Oh, no. Is that really happening?
I love the Scream franchise. Heck yeah, it's happening.
Oh, my goodness. I had not heard of Megan, so I guess I'm not watching enough television.
A lot of younger kids are into it, so that's something that I think, could have more momentum.
All right, on television, that old-fashioned thing that some of us still watch, the Golden Globes are back tomorrow. Is it still relevant? Does it still matter?
You're asking the question that I think a lot of Hollywood is asking right now. And NBC is asking this as well, because they only signed a 1-year contract with the Hollywood Foreign Press Association, otherwise known as the HFPA, following that intense scandal in 2021. But ratings have just been on a downward trajectory. In February 2021, this was the last time that we got a live telecast of the Globes. Ratings hit a 13-year low of 6.9 million viewers. And if we compare that to pre-pandemic times, January 2020, ratings came in at 18.3 million. So a very steep fall from grace there. And I think a large part of that had to do with that controversy, the LA Times publishing a scathing expose against the HFPA, detailing allegations of self-dealing, bullying, racism within the organization. And that really convinced a lot of A-listers to pull back, studios to pull back. Since then, the HFPA has enacted some sweeping reforms, such as a new board of directors, diversity and inclusion programs. But is it too little, too late? And I think the ratings will show us that tomorrow night. But a Tuesday versus a Sunday, I don't have high hopes for this.
Largely speaking, it just feels like we're in a post-award ceremony era.
Totally. It's very different from years past.
Yeah, just people don't care as much. But 6 million viewers ain't bad in this era, live viewers. Ali Canal, thank you. Good stuff. All right, shares of cannabis lifestyle and consumer packaged goods company Tilray struggling today, down more than 6% on today's earnings report. The company losing $61 million compared with the profit of just under $6 million in the prior year's quarter. Net revenue falling 7% to $144 million. So what is the path forward for cannabis companies? Joined now by Tilray Chairman and CEO Irwin Simon. Irwin, good to see you, sir. So looking at the quarter, we'll get to some positives, including beer and alcohol. What did you learn when it comes to the cannabis industry and the current state of it?
So number one, David, sales were not really down in the quarter on a constant currency basis, number one. And the $63 million loss is a GAAP loss, but in that is amortization and other GAAP accounting. There's absolutely some cash from interest and CapEx and stuff like that. So I don't want to scare people that we lost $63 million in full cash there. The company generated $29 million of cash. And, with that, we maintain the number one cannabis position in Canada. We're the number one cannabis, company from a medical standpoint. Europe have a strong beer and spirits business and wellness business. So there's a lot of good going on. Unfortunately, the cannabis industry in general has been taking its hits. And, without full legalization in the U.S., without any safe bank, and without legalization in Europe, it's ultimately piecing it together as a consumer packaged goods business in multiple facets here. And that's what Tilray is doing. But I got to tell you, we have strong brands. We have a strong balance sheet. We're generating cash. We got a plan to growth, and it just depends upon legalization. And as a company today, we can't depend upon the government, and the government took a long time to get a Speaker of the House. We got to depend upon our own future and grow where we can grow. That's not doesn't depend upon legalization.
Boy, I mean, I can't help but wonder what you made of that whole mess in the U.S. House and the 15 plus rounds it took to elect a House Speaker. What is your level of optimism when it comes to U.S. legalization and separately of safe banking?
So let me step back. Listen, what do I think of last year? You had a Democratic Congress, you had a Democratic Senate, you had a Democratic president that talked about it, in campaigns back in 2020. And nothing happened. Not really one thing happened in regards to any legislation that passed. The only thing that happened was the president pardoned, some individuals that were no longer in prison, and had some, charges against them that were long gone. He did say he sent, the bill down to the health benefits to get looked at, but nothing ever came of it. So, number one, frustrated that nothing happened in 2020 and nothing's happened at the end of 2022. Nothing happened to Safe Bank, nothing happened with Moore, nothing happened in regards to rescheduling, cannabis. I live in New York City. I walk around. There's a new store that opened down in Greenwich. There's lines and lines around the corner. 63% of Americans today want cannabis legalized. David, in Canada over the last couple of years, we've paid $250 million in taxes that got put back into the economy there. We've created, over 750 jobs, built out facilities for $1 billion. And we have taken, bad cannabis off the street that's laced with fentanyl and stuff like that. So it is frustrating, but Tilray's not going to sit by and depend upon the government. We as a consumer packaged goods business are going to grow our business in cannabis, beer, spirits, and wellness foods.
And what is your message to Congress? What's it going to take to get change? We've got a slowing macro environment, recessionary fears. What is it going to take to get your message through to Congress?
Listen, again, we all have lobbyists. We're all pounding on the table here. The message to Congress is this here. There's opportunities in tax dollars. There's opportunities to take bad products off the street. There's opportunities to deal with an illicit market. There's opportunities to create jobs. There's a lot of social opportunities out here in regards to, the social economic opportunities here. So cannabis, as a product in regards to medical standpoint, for sleep, for anxiety, for pain, there's so many benefits out there from cannabis that is regulated and goes through quality control that I am just amazed that our, politicians are not looking at it in a way that it should be looked at. And come back to kudos to Canada. Yeah, you're paying high taxes, but Canada is the only country, today that's out there where cannabis is legalized from a recreational standpoint. And listen, they're taking in a lot of dollars for tax dollars. They're created a lot of jobs. And, they're removing a lot of the illicit market products off the streets.
A big positive in this report was, of course, beer and liquor. You acquired Sweetwater, you acquired Montauk Brewing, and you also acquired Breckenridge Distillery. How optimistic are you of continued growth in that avenue in the year ahead?
Good question. Right now, we cannot touch, the cannabis plant in the U.S. We trade on the Nasdaq. We trade on the Toronto Stock Exchange. I put a plan out there to grow to a $4 billion company and create Tilray brands. With that, our focus has to be on growing in the beer business, growing in the spirits business, and growing in the wellness area that are adjacencies to the cannabis business upon legalization. And you know what? Diageo, Constellation, Brown-Forman, they have pretty good multiples and pretty good margins out there, and they're pretty good businesses. So I don't mind being in those businesses. I was in the wellness business for over 25 years. know, the benefits of health and wellness and good consumer products out there. So I like that category also.
In 10 seconds, is there any plans to combine Montauk Brewing or Breckenridge Distillery with cannabis?
So absolutely. And again, that is the ultimate, end game here, that one day our Breckenridge, which is bourbon that contains alcohol, will contain THC. Our Sweetwater Brewery will contain THC instead of alcohol. The same with Montauk upon federal legalization. And, there is drinks in Canada today that you can sell through cannabis stores, that are infused with THC. They're good tasting drinks, no calories, no hangover afterwards. So we see a big, big business. And just think about it. We got brands, both in alcohol, we'll have brands in THC. We have the distribution out there. So Tilray is really set up for some good things to happen. Cannabis really, it's only 4 years that it's legal in Canada. Tilray Brands is a company, with $700+ million of sales, strong balance sheet. It's only been around for 2 years, and we're in great categories. But unfortunately, we're dependent upon legalization to be able to drive some of our growth.
Hopefully, Congress gets that message. Tilray Chairman and CEO Irwin Simon, great to have you, sir. Appreciate it.
Thank you very much for having me on. Nice to see you,
Shauna.
Former McDonald's CEO Stephen Easterbrook settling with the U.S. Securities and Exchange Commission over investor fraud allegations. Easterbrook was originally fired from McDonald's in 2019 for having an inappropriate relationship with a subordinate. But after an investigation, McDonald's claimed that he covered up additional inappropriate relationships with other employees, so the company sued him to claw back compensation he had received as part of his firing. The SEC charged Easterbrook with making false and misleading statements to investors about the circumstances leading to his termination. Easterbrook neither admitted nor denied the charges. He agreed to a civil penalty of $400,000 and will not be allowed to serve as a company officer or a director for 5 years. The SEC also accused McDonald's of violating securities laws, but the agency did not impose fines due to the company's, quote, substantial cooperation with its investigation into Easterbrook. Well, coming up, a blue wave of impersonations. Our next guest telling us how he managed to trick Twitter's new checkmark verification system by posing as a U.S. senator. Don't go anywhere.
JP Morgan CEO Jamie Dimon just finished speaking at the bank's 41st annual healthcare conference. Yahoo Finance's Anjali Kamlani joins us now from the conference with more. Always making news on his predictions for the economy. What did we hear, Anj?
Well, Dave, I'm sorry to tell you that this is an off-record conversation, but I can tell you he did speak broadly about the economy, some of the topics you might expect, including where investors should really be looking in the upcoming year, as well as broader economic topics like oil, as well as politics. But what really is the big highlight of this conference is always the deal making. And of course, we're surrounded by bankers and investors here in the St. Francis Westin in San Francisco. And it's really interesting to see that this year it hasn't quite dealt the volume of deals that one would expect on the first day of the conference. In the past, we've seen some of the largest deals on record days before this conference. But this year, not quite the numbers you're looking for. We've seen AstraZeneca talk about acquiring Syncor, QIAGEN acquiring Verigen. And I found out that one is a little bit interesting. It does tie into some current events when it comes to DNA testing and the like. And then the Casey Amert acquisition. So all of those deals totaling really less than $5 billion, which is not a big number when we've seen tens of billions in the past. So really a quiet start to this year, but some are hoping that the return to in-person for this conference is going to lead to some more deals down the line. So we'll just have to stay focused and stay tuned.
All right, Anjali Kamlani, thanks so much for the latest from that conference that so many on the street are following. All right, Twitter facing more chaos in the new year. Bloomberg reporting at least a dozen more staff cuts at Twitter on the global content moderation side of the business. And workers already laid off from the company are reportedly not getting the severance that they were promised. Employees detailing to Forbes and Wired the lack of communication from Twitter about their severance deals. To add to the mayhem, our next guest is saying that Twitter's new verification system to get that blue check mark doesn't work. Jeff Fowler, Washington Post, a technology columnist, joining us back here. Jeff, it's great to see you again. So this new updated verification system certainly has been or seemed to have been a priority for Musk. Issues with it. This is the second time that you were able to impersonate Senator Markey. Walk us through how you were able to do it and the biggest issues with this problem.
Yeah, oops, I did it again, I guess you might say. What I did was I wanted to test the claim by Elon Musk that his new Twitter Blue verification system would be, to use his words from a tweet, manually authenticated before they would give out a check mark to an account. So they said really they were going to build trust back into Twitter with this. So I said, okay, let's check that. So once he launched this in December, I went about trying to make a fake account for Senator Edward Markey from Massachusetts and get a check mark for it. Now, I got permission from Senator Markey to try to impersonate him. And indeed, Twitter had put some new barriers up in place. They made me wait a little bit longer, but at the end of the day, I was still able to do it. I was still able to get the account Senator Ed Markey verified. At no point did Twitter ask me to show them an ID or to show them an email or really do anything to prove my identity other than hand them $8 for the check mark.
At what point did they realize it wasn't genuine? What does it say about Elon Musk's overall management of the platform?
They realized it when I published it in the Washington Post and then deactivated the account. The same thing happened back in November when I tried this experiment for the first time with Senator Markey and a comedian. They realized it after I published about it in the Post. Look, Twitter can say impersonating accounts is against our rules and we'll shut them down. But it is 2023 and it is not good enough to just say something is against the rules when it comes to the trust and safety of a social network. We know that disinformation has real world consequences. And so we have every reason to expect that Twitter is going to do better with this, especially when they're charging now people $8 or $11 if you're using an iPhone for this privilege.
So, Jeff, considering all this, the lack of ability really to weed out some of the impersonation that is going on the platform right now, from the consumer aspect of things, are you expecting a backlash, or how much do you think the consumer cares about something like this?
I think we didn't really talk about it that much before Elon Musk came along. But one of the things that made Twitter into the cultural icon that it is that it became the official place on the internet for people to post apologies, right? And you could go on Twitter and you could see if there was like the screenshot of the Notes app of somebody saying, oh, I shouldn't have done something or whatever. And you could trust that it came from them. You could trust that if a government agency was talking on Twitter, that it actually was them. Or if a corporation was there talking. Under Elon's leadership, Twitter is destroying some of that trust that we have. And that to me just is part of eroding the value of Twitter for its users. I know that since Elon Musk joined, I haven't, quit it in a huff yet, but I'm still using it less because I think the chances are higher than ever that I'm going to see some information that's completely fabricated, tries to mislead me, and not have any way to know any better.
So we're understanding that long tweets, really long, could be rolled out next month. Some say up to 4,000 characters. What would be the impact of that? And Jeff, you've followed this platform a long time. In any way, has Elon Musk improved the platform or the experience on Twitter?
Well, as for the longer tweets, okay, maybe. I mean, I'm a journalist and I write very long stories, but it's not something that I've been, holding out, waiting for. So I guess maybe some people might want it, but that's not going to give me a reason to want to spend $8 a month on Twitter. In terms of other changes, again, I really haven't seen Elon Musk focus on the things that I think would really be useful for people. For example, he keeps claiming that that Twitter Blue is going to reduce the number of ads for users or make them more targeted or more useful, I guess. But all I've seen as a user is the number of ads on Twitter skyrocket, go through the roof. It seems like every third tweet I look at now is an ad, and that's not a great experience. So I think one of the challenges that Elon Musk faces is he doesn't really do market research. He doesn't really listen to his users other than these polls that he does every once in a while. He seems to think that he's got all the ideas and all the answers, and that can be a really dangerous form of leadership when it comes to designing products that you want people to pay for.
Jeff, well, speaking of leadership, Elon Musk has said multiple times that he does plan to step down as CEO of Twitter and really focus most of his efforts on Tesla. What do you think about that transition, what that could potentially look like, and whether or not you think Elon Musk is really going to be able to take that more so hands-off approach?
So I'm also a Tesla driver. And gosh, I hope he turns his attention back to Tesla because they just pushed through a really awful software update for the UI. I mean, can you believe that it's 2023 once again, and a car company is continually moving around the buttons that you need to operate the car? That's not a good thing to do. That really, again, not listening to their users, to their drivers, to their owners about the conveniences that they want, and really just trying to follow their own path. So look, maybe Elon will do this, but then you got to kind of wonder, why did he buy this thing in the first place? If he, and does he really have the ability to hand over the reins to somebody else? I don't know. His personality has not shown that that's necessarily something he can do. What I really worry about is that Twitter used to be a place where you could go to kind of find information and be maybe surprised by something or delighted. And it seems like, again, ever since Elon took over, it's become a social network about Elon Musk. So much of the conversation there is about him. And I don't care. I don't want to talk about him anymore. I want to go back to a Twitter where I got to sort of see cool things and explore new ideas. And that was far less about politics and people attacking each other and tribalism. I just think he doesn't have the right ideas about how normal people really want to use this thing.
Certainly has gotten tiring. Not a day, it seems like, goes by where we don't mention Elon Musk, Twitter, or Tesla at least once during the show. So I'm right there with you. Jeff Fowler, great to have you. Thank you. Well, coming up, making sense of all confusing and sometimes conflicting economic data. We are going to break down the best strategies for planning your next career move during this economic uncertainty. Stick with us.
A slew of economic information, interest rate hikes, jobs reports, CPI data. Can be a lot for people to absorb. To help us make sense of what all this means for workers, Yahoo Finance contributor and Brown Ambition podcast co-host Mandy Woodruff-Santos joining us now. Mandy, nice to see you. So what should employees be doing to prepare for the worst?
Honestly, I think the first thing is to just take a deep breath. Things are a little shaky right now, and they're highly confusing. There are several signs that the job market is still really hot. I mean, we see quit rates still inching their way actually up a little bit. Wage growth, although down slightly, is still fairly steady, especially relative to where we were before the pandemic. So for workers, what can this mean for you? Also, we see tech layoffs happening. My first tip is really for you to think about your own financial house and what can you do to create some sense of financial security? Because even though things are good now, I'm a realist, and it's very likely that businesses could continue to make big pivots throughout this year if a recession continues to loom over us. And by pivots, of course, that means potential layoffs. So definitely be saving and paying down your debt, but I wouldn't let that stop you from making some big career moves if that's what you want to do in 2023.
Well, Mandy, for those out there who are looking to make a move, I think some of them are struggling with what they need to pay attention to, what they can kind of just ignore at this point. What are the most important things that they need to pay attention to at this point?
You've got to look at your personal professional economy. So what sector are you in? And look for data and research that supports what our job openings look like, what are hiring rates looking like for your particular sector. Maybe if you're in tech, you know that things are going to be highly competitive because even though tech companies are still, some of them are still hiring, of course, you have lots of competition with tens of thousands of workers hitting the job market at the same time due to layoffs. But in other fields like healthcare, hospitality, leisure, education, we've actually seen big job gains, and construction, shockingly enough, as well. So it depends on your personal professional economy, what your job search may look like. I love to tell people through my practice as a career coach, when you're in the interview process, always take those calls, right? But I would definitely say, as you're taking those interviews, be clear on the kinds of questions you're going to ask that can give you some clues as to the health of the company. Ask them, frankly, have you had to make any layoff decisions in the past year? What's your plan for the economic challenges if they were to come in the future? So that you get a sense of, is leadership taking this seriously? And then, of course, will you be eligible for severance if you were to join and get laid off, less than a year from now? I would think those are two good questions to bring to the table if you're interviewing this year.
Okay, and after landing a new job, a worker could have a choice of a sign-on bonus or equity. Pretty good choice to have.
Yeah.
Which one is best?
I mean, I'm typically an equity gal. I love it. But with all signs of the market continuing to really have some struggles, especially when you think about which companies typically give equity, you're thinking about often tech companies. So I would say negotiate for a cash sign-on bonus instead of equity, because with the cash sign-on bonus, you're getting a lump sum right when you start, right? Versus an equity grant, which is not yours right away. Maybe a little bit of it is, but typically you have to stay with the company for 3, 4, maybe even 5 years before you're fully vested and that money is yours. So with the way the market's looking, it may be a safer bet to opt for that sign-on bonus in advance. And then I would say save it, because you never know what could happen. And that can be a nice little nest egg for you if you do end up getting laid off down the line, so that you don't feel as much pressure just to jump back out there and take the next job that you get.
Sign me up either way. Mandy Woodruff-Santos, good to see you. Thanks so much. All right, my stock to watch for tomorrow, Bed Bath & Beyond. Apparently, no news is good news ahead of the company's official third quarter earnings report, what some feel could be their final quarterly earnings report. Check out the stock. Whoa, it soared today, up 23%, kind of traded like a meme stock today. Last week, the company warned investors that bankruptcy is on the table as it struggles to deal with inventory constraints and reduced credit limits. Bed Bath & Beyond expects to report that sales dropped over 30% to $1.259 billion from $1.878 billion in the same quarter last year, and a net loss of $385.8 million. The NFL playoffs are set, but one player who won't be partaking in this year's action could still help fans win some money during the Super Bowl. We'll tell you which player and how much money you can win next.
Gronk speaking.
Gronky baby, how does a FanDuel Super Bowl commercial sound?
Great. What do I got to do?
FanDuel is putting up a $10 million payout when you kick a field goal during the Super Bowl.
Wait, I don't kick, I catch.
Kick, catch, who cares? It's football.
What?
And it's going to be live.
Live?
In front of millions of people. Linda, it's called the Kick of Destiny.
What the heck is Kick of Destiny?
Good luck. See you in Phoenix. Don't miss.
Oh, boy. I better call Vinatieri.
Gronk has some practicing to do over the next couple of weeks. Online sportsbook FanDuel placing its own bets on this year's Super Bowl. The gambling company will run an ad featuring a live field goal kicked by former NFL tight end who you just saw there, Rob Gronkowski. Fans who bet $5 or more on this year's Super Bowl will be entered into a contest. Now, if Gronk makes that 25-yard field goal, each bettor will split $10 million in free bets. Likely won't get paid out a lot, but certainly speaking to the larger issue here, bringing a lot more attention onto these online sportsbooks, which coming off has been a trying year for a lot of these companies.
Yeah, kind of like trying a 25-yard field goal. Not always that high percentage, but Adam Vinatieri coaching them, I will bet. But look, it'd be great if there are only 10 people betting and you get a shot at $1 million, but there's probably going to be 1 million people with a shot at like $10. Yeah. Still, it is free money, and it is an interesting element when you talk about Super Bowl ads. Can't recall in recent years a live feel for the moment commercial, and that is a smart play for FanDuel. Although it is interesting, the large thing you're hearing about these sports gambling companies is, all right, they're going to cut spending. They've been overspending to lure new players, and here's what they're doing, spending $7 million, an all-time high for a 30-second ad. Do give them a lot of credit for having it live and giving fans some involvement. And the payoff here is they're going to get a couple of weeks here of play on that ad, generate excitement. That is the new sports marketing theory, that you get a couple of weeks bounce out of these commercials. So this is a smart play, but to your point, it's been a really tough go. DraftKings down more than 50% in the last 12 months. You know, FanDuel is owned by Flutter. That's a different one. But Penn down 36%. Caesars is down 50%. It's time to make investors some money, and it's got to start the biggest gambling day of the year.
It does. It makes a lot of sense, I think, for them at least to be picking this year as the first year. Yes, they need to see some growth. We know investors have been pretty much fed up with their path to profitability when it comes to a lot of these names, which has certainly been placing pressure on the sector overall. When it comes to FanDuel, though, right now they account for about 40% of the U.S. market share when it comes to sports betting. So how big of a lead maybe, or how much wider they could potentially grow that is the question there when they are getting more and more competition. This year, at least, it is legal in 18 states. Ohio just coming online this month. So we'll see whether or not it pays off, but they certainly are making a big bet there.
So is DraftKings. They will have a Super Bowl ad also in that $7 million for 30 seconds. Kevin Hart will be the star of that, so you will feel a real presence of sports betting companies in the biggest sports gambling day of the year.
All right, well, that'll do it for us today on Yahoo Finance Live. Thanks so much for joining us. We'll see you right back here again tomorrow afternoon. Have a good night.